You know that feeling when someone pitches you an investment opportunity and everything about it sounds amazing, but there's this tiny voice in the back of your head saying, "This seems too good to be true." Yeah, that voice, it's usually right. And here's what's crazy. That exact same scam that made Jordan Belfort nearly $1 million a week in the 1990s, it's happening right now, today, probably in your Twitter feed. Except instead of a smooth-talking stockbroker in a pinstripe suit, it's your favorite gaming influencer shilling a coin with a dog on it. Look, I need to tell you something that's going to make you mad. That scene in Wolf of Wall Street where Matthew McConaughey tells Leonardo DiCaprio that
Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi.
And then Leo says,
Fugazi, it's fake.
That line has been eating at me for 7 years. Because you know what? It does matter. It matters a lot. And today, we're going to pull back the curtain on exactly how Stratton Oakmont turned that philosophy into a money-printing machine that destroyed thousands of regular investors. But before we dive into one of the most brilliant and devastating financial frauds in American history, do me a favor. Smash that subscribe button, hit the like button, and drop a comment below telling me if you've ever been pitched an investment that seems sketchy. Because I guarantee by the end of this video, you're going to recognize the warning signs of a pump and dump scheme. And trust me, you're going to need that knowledge. All right, let's talk about how you steal millions of dollars in broad daylight. Here's what most people don't realize about the 1980s and 90s stock market. It was basically designed to extract money from you. Think about this. Today, if you want to buy Tesla stock, you open Robinhood, type in TSLA, hit buy, and boom, zero commission. Takes 15 seconds. Back in the 80s, you had to call an actual human being, a stockbroker, and that person would execute your trade. And here's the kicker. They charged you up to 2% of your entire trade just to press a button. Let me put that in perspective. If you wanted to invest $10,000, you paid $200 just for the privilege of buying stock. The broker personally pocketed $100 of that, and their firm took the other $100. Now, you might be thinking, okay, but at least these brokers were giving good advice, right? They were helping people pick winners. No. Here's the thing, and this is where it gets really interesting. These brokers had absolutely no idea which stocks would go up or down. None. Warren Buffett doesn't know. Your broker definitely didn't know, but they had a very powerful incentive to make you think they knew. Commissions. The more trades you made, the more money they made. It didn't matter if you made money. It didn't matter if you lost everything. Every time you bought or sold, they got paid. It was a system built on volume, not results. And this is the psychological shift you need to understand. When someone's income depends on you taking action, their advice stops being about what's best for you and starts being about what's best for them. So, Jordan Belfort starts his career at LF Rothschild, a respectable exchange brokerage. These firms traded stocks listed on real exchanges like the NYSE. There were rules, there was oversight, there were actual people on the trading floor who could get kicked out if they acted like complete criminals. But then Jordan Belfort discovers something much more profitable: over-the-counter stocks. Look, here's what you need to understand about OTC markets. These are companies that can't or won't meet the requirements to be listed on real exchanges. We're talking about businesses so sketchy that when you call their headquarters, the CEO's mom might literally answer the phone. And the fees? Absolutely insane. While exchange brokers were making 1 to 2% commissions, OTC brokers were taking 10 to 20% cuts. In the movie, they show 50%, which is Hollywood exaggeration, but even at 20%, think about what that means. If a company needs to give away 20% of the money they raise just to find investors, what does that tell you about the quality of that company? It tells you that literally no legitimate investor wants to touch them with the 10-foot pole. These were desperate companies selling radar technology that probably didn't work, pharmaceutical research that would never get approved, and mining operations that would never produce anything valuable. But they had one thing going for them. They were willing to pay massive commissions to anyone who could find the money. And Jordan Belfort? He became an absolute master at finding unsophisticated investors who didn't know any better. This is where the story gets diabolical, and honestly, it's kind of genius from a purely mechanical standpoint. which is exactly what makes it so dangerous. Belfort founded Stratton Oakmont and developed a system so effective that it would make him nearly $1 million a week. Here's exactly how it worked. Step 1. The setup. Jordan would find a small company, preferably one worth less than $100 million, small enough that you could actually move the price with relatively modest buying. He'd then call up his rat holes, trusted associates who weren't officially connected to his firm, and have them buy up a massive position in the stock. Let's say the stock is trading at $2. The rat holes might buy $500,000 worth. That's 250,000 shares. In a small company, that's a significant chunk of ownership. Step 2. The pump. Now, here's where the Jordan Belfort's army of brokers comes in. He'd instruct every single person on his sales floor to start aggressively pitching the stock to their clients. Cold calls, relentless pressure, fear of missing out. This stock is about to explode. I've got inside information. This is the next Microsoft. And because dozens of brokers are all pushing the same stock to hundreds of clients, suddenly there's massive buying pressure. The stock that was $2 yesterday is now $4, then $6, then $8. Step 3. The amplification. Here's where the psychological trap. As the price goes up, it becomes easier to sell to new investors. The broker can now say, look, this stock has tripled in value this week. Get in now before it's too late. This is where it gets really interesting. This creates a self-reinforcing cycle. Rising prices attract more buyers, which pushes prices higher, which attracts even more buyers. It's a feedback loop of greed and FOMO. Step 4. The dump. Once the stock hits a predetermined price, let's say $10 per share, Jordan gives his rat holes the signal to start selling. Remember, they bought at $2. They're now selling at $10. That's a 400% profit. But here's the truly criminal part. While the rat holes are selling, Stratton Oakmont brokers are instructed to make it impossible for regular clients to sell their shares. They don't answer phones, they lose sell orders, they tell clients the market is closed when it isn't. This gives the rat holes time to completely exit their positions before anyone else can. Step 5. The collapse. Once the rat holes are out, regular investors suddenly get their phone calls answered. They can finally sell. But by this point, there are way more sellers than buyers. The stock price collapses. That $10 stock is back to $3, then $2, then maybe even $1. The rat holes made $2 million on their $500,000 investment. They give most of that to Belfort, keeping maybe $200,000 as their cut. Belfort walks away with $1.8 million. His firm also made massive commissions on all those trades. And the regular investors? They lost everything. Now you might be thinking, okay, but surely this couldn't work with legitimate public companies, right? The NYSE has rules. Well, yeah. Jordan Belfort found a way around that too. When Stratton Oakmont started underwriting IPOs, taking companies public for the first time, Belfort saw an opportunity to supercharge his scheme. He'd combine the Wild West nature of OTC stocks with the credibility and liquidity of public markets.
Here's how. His rat holes would buy pre-IPO shares. The company debuts on the NYSE. Belfort's army of brokers creates a buying frenzy. The stock opens and immediately jumps 50%. But now, something different happens. Because it's on a public exchange, other investors who have never heard of Stratton Oakmont see this IPO popping off and think, wow, this must be a great company. They pile in, adding even more buying pressure. The rat holes use this chaos to silently dump their shares at massively inflated prices. By the time the dust settles and people realize the company isn't actually worth anything close to its current price, the stock craters and thousands of people lose their savings. Belfort had effectively weaponized the trust people have in public exchanges to run an even bigger scam. For those of you who haven't connected the dots yet, this is called a pump and dunk. And here's what's going to blow your mind. It's making a massive comeback. For about 2 decades, this scheme was mostly dead. Online brokerages, instant access to information, zero-commission trading, and better SEC enforcement made it really hard to pull off. But then, cryptocurrency happened. Look, I'm not saying all crypto is a scam, but I am saying that loosely regulated crypto markets have created the perfect environment for pump-and-dump schemes to thrive again. The mechanics are identical, the only differences are cosmetic. Coked-up stockbrokers in Manhattan to Discord communities and Telegram groups. Cold calling from fancy offices to Twitter hype and YouTube shills. Penny stocks with questionable business models to meme coins with dog logos and zero utility. Small cap companies to low market cap tokens. Some influencer with 2 million followers tweets about a coin. Their followers buy in. Price goes up. More people see it trending and FOMO in. The influencer and their buddies, who bought in early, dump their bags on everyone else. Price collapses. Repeat. I've seen this play out dozens of times in the last few years. The exact same playbook Belfort used in 1995, just with blockchain instead of stockbrokers. Here's what most people don't realize. The reason pump and dumps work isn't because people are stupid. It's because they exploit fundamental psychological vulnerabilities we all have. Fear of missing out, FOMO. When you see something going up rapidly, your brain screams, "Get in now!" It's the same instinct that made our ancestors chase after food before someone else got it. Social proof. When lots of people are buying something, we assume they know something we don't. We trust the crowd, even when the crowd is being manipulated. Confirmation bias. Once you buy in, you start looking for reasons why you made a good decision. You ignore warning signs because admitting you were wrong feels terrible. The sunk cost fallacy. When the price starts dropping, instead of selling, people buy more to average down because they can't accept the loss. This is exactly what the scammers want you to do. Understanding these psychological triggers is your best defense. All right, here are the specific warning signs that you're looking at a potential pump and dump. 1. Urgency and FOMO language. Anytime someone is pressuring you to act now or telling you you'll miss out if you don't buy immediately, massive red flag. Legitimate investments don't have expiration dates. 2. Promises of guaranteed returns. Nobody can guarantee returns on investments. If someone tells you a stock or coin will definitely go up, they're lying or stupid. Probably both. 3. Unverified insider information. Claims about secret knowledge or insider tips are almost always manipulation tactics. Real insider trading is illegal. Fake insider trading is just marketing. 4. Low market cap plus high volatility. If a stock or coin has a market cap under $100 million and the price is swinging 20 to 50% daily, that's a casino, not an investment. 5. Aggressive social media promotion. When an asset is being pushed hard across multiple platforms by influencers, celebrities, or random accounts, someone is orchestrating that campaign, and they're doing it because they plan to dump on you. 6. Lack of fundamental value. Ask yourself, what does this company actually do? What problem does this coin actually solve? If the answer is unclear or sounds like buzzword soup, run. 7. Difficulty selling. If you notice that selling is harder than buying, whether it's technical issues, high fees, or long processing times, you might already be caught in a pump and dump. Look, here's the thing. I can't stop people from running pump and dump schemes. They're too profitable, and the crypto space is too loosely regulated. But I can give you the tools to avoid being a victim. Action step 1. Never invest based on social media hype. I don't care if it's your favorite YouTuber, a celebrity, or that guy from high school who suddenly became a crypto expert. Do your own research. Understand what you're buying. Action step 2. If you're going to invest in small cap stocks or low market cap crypto, only invest money you can afford to lose completely. I mean, completely. As in, this money could go to zero and your life doesn't change. Action step 3. Set clear exit strategies before you buy. Decide in advance, if this goes up 50%, I'm selling half. If it goes down 20%, I'm out completely. Emotion is the enemy of good investing. Action step 4. Diversify relentlessly. Never put more than 5% of your portfolio in any single speculative investment. The people who got destroyed in Belfort schemes had their life savings in 1 or 2 stocks. Action step 5. Educate yourself on basic market mechanics. Understand market cap, volume, liquidity, and how prices actually move. The more you know, the harder you are to scam. Here's the uncomfortable truth. The reason Jordan Belfort made $50 million defrauding investors wasn't because he was a criminal genius. It's because he understood something fundamental about human psychology. We're wired to chase quick profits and follow the crowd even when it leads us off a cliff. And the people running pump and dumps today, they know exactly the same thing. They've studied the playbook. They've just updated it for Discord and Twitter instead of cold calls and boiler rooms. But here's the good news. Once you understand how the game works, you can't be played. You'll recognize the patterns. You'll see the manipulation for what it is. And instead of being the person left holding a worthless asset, you'll be the person who walked away. The Wolf of Wall Street is an entertaining movie, but it shouldn't be your investment strategy. Remember, if someone is aggressively pitching you an investment opportunity, ask yourself one question. Why do they need my money? Because if it was really such a great opportunity, they'd keep it to themselves. If you found this valuable, subscribe for more financial deep dives. Hit that like button. And seriously, drop a comment telling me if you've ever been pitched something that sounded too good to be true. I read every single one. As always, massive thanks to my channel members and Patreon supporters who make these videos possible. You're helping people avoid getting scammed, and that matters. Stay smart out there, because the wolves are still hunting.